Good morning, Illinois. I don't even know what state I'm in. Texas, Indiana. What are we doing this week? This is our 120th webinar that we've done since COVID. It's not how we want to act. It's not what we want to do, but we're so glad to be here with you in your living room or your office or wherever you are. I am not in my studio, so if I forget to look at the camera, it's not my fault. I'm old. It's hard to learn a new trick. It's the best I can do. Let me just do a quick PowerPoint here. Hopefully you all can see this and I'm doing it correctly. Hi, Karen. Thanks for joining us. Turn your camera off during the keynote, then we'll get to you in a little bit. This is our 17th annual Transportation Logistics Conference, December 9th. We're here for a couple hours. I got to do this because I've been giving this speech now for a few months, but without sponsors like this, we would not have been able to pivot to do online events. And these are challenging events to pull off, and they're not free and they're time consuming for our staff. So without these people, we wouldn't have been able to still bring you great information. And coming in 2021, we're going to do hybrid events in a lot of locations. So you'll be able to choose whether you want to be on Zoom or whether you want to be live and in person. And those are difficult too. So without all this support, we wouldn't be able to make it happen. So thank you, Arco Murray, CenterPoint, McKiernan, hope I'm saying all these right, DSI Development, Ware Malcolm, Meridian Design, I-39 Logistics, Hillco, Peak Construction, Northwestern Indiana Forum, Lake County, Indiana Economic Alliance, NIPSCO, Crew Chicago, Meisner Group, Power in Chicago, and then our masonries and bricklayer friends who are great supporters of our program. This is us, RE Journals. In case you're just following Chicago industrial properties, we have 6 publications across 17 states. Next year, we'll do over 150 events, live and online. We are doing we're going to have opening remarks today. So fantastic. We've got Deryl MicKissack here is going to kick us off. I'm going to stop screen sharing, Deryl. And when you're ready to go, I'm going to disappear. I'll still be here if you need anything, but this is your show now.
All right. Well, good morning, everybody. And it is a pleasure to be here with you today. Of course, like Todd said, I wish we were all in person. It just makes it a much better event. But, you know, I guess we're all settling in and getting used to this video style conferencing. Well, yesterday I had the opportunity to read RE Journal's 2021 forecast. And I have to say it's disturbing to see that there are going to be so many disruptions that will continue for the industrial real estate industry in 2021. You know, well, you're not by yourselves because, of course, that's happening across the country in all real estate development, and people are really uncertain about what's next. So sort of holding up, moving forward. There's going to be a new normal that we're all going to have to find in the design world and in the construction world. And how do we now service our clients? How do we move the supply chain forward? It's going to take a lot of innovation. It's going to take us coming together and coming up with great solutions. So today, we're really here to talk about, you know, economic development in transportation and logistics. And I think that's an excellent topic. But before we go there, we cannot overlook what has happened to us in 2020. It has been an unprecedented year. And what I look at it, you know, after about 7 or 8 months of living through this pandemic, you know, what hit me was that we have been a true capitalistic society. Almost everything we do depends on capitalism, but humanity just smacked us all in the face. It brought us to a screeching halt. And so now we're at this point where I feel we're going to have to deal with this humanity issue before we can economically move forward. You know, for us to really have a recovery, we're going to have to all come together. And what better industry to do that than the design and construction industry? Because that's what we do all the time. We're always meeting people's expectations or managing people's expectations. How do we do that? Well, we do that by sitting around the table and listening to every stakeholder's visions and dreams. And then we look at the facts, the true facts. That's the other problem with today. Everybody has a different perspective on what the truth is, but we're all looking for the truth. And we know in the construction world that the facts are undeniable, that they cannot be challenged, that everybody can see it. So that is the truth of what's going on. So we've got to peel back the onion and get down to the truth and try to all look at the same truth as opposed to looking at the truth through blinded colored glasses. So once we've heard all the stakeholders' expectations, we look at the facts, we sit there rationally, and we come up with the optimal solutions. And that's where I feel we have to go as a country now, and even as an industry, in order to move our country forward. You know, at my company, we believe in giving everybody a seat at the table. We celebrate diversity. And, you know, the philosophy in doing that was really confirmed when I had the opportunity to go out to Apple's headquarters in Cupertino, California, the Ring. I'm sure you've heard of the Ring. So I happened to be there at lunchtime, and a lot of the employees were out going to the lunch area, which is huge and wonderful. And what I noticed is that they had everybody there, every age, you know, so not everybody there is running around 20-year-old and a millennial, okay? They're baby boomers. They had every gender, and they had every race and ethnic group that you could imagine. And so no wonder Apple is the Tiffany's of the FANG, because they have made an investment in listening to everyone, everybody's story, everybody's perspective on life in order for them to produce a product that sold more than any other product in the world. So McKinsey, for example, they've been studying diversity in the workplace since 2015. And what they come back with every year is that diversity produces higher performance, happier employees, and definitely boosts the bottom line. So, you know, their last report actually was labeled Diversity Wins. So, you know, what is the problem? How do we get past this? You know, our business, we're used to building bridges. And what do bridges do? Bridges span over obstacles, structural obstacles. So we can build bridges, whether they're literal or there are what we need to move forward in just dealing with our brothers and sisters across the nation and around the world. You know, many companies today are now stepping up. If you look at the NASDAQ, you know, they've come out and said, okay, we want every board, every company that's on the NASDAQ to have a woman or a minority or LGBTQ person on their board. And I think that is just so important. The AEC industry can really have transformational change in this arena. And the reason why is because the amount of money that we spend as an industry, we spend $1.3 trillion a year on construction, and we employ millions of people. We are in every place, every area of the country, whether it's rail, roads, bridges, airports, all of these places. So we can have real change in this area. Today, 88% of construction workers and 84% of professional workers in the engineering and architectural profession are white. and only 10% of the workers and 26% of architecture and engineering professionals are women. And it gets even worse when you go to minority groups. So we have this, and we have a major labor shortage. So what is the problem? Why is it that we can't train these people or give these people opportunity to be a part or a stronger, significant piece of our workforce? You know, I remember my first job, and my boss had a life-size Confederate flag behind his desk, and we lived with that every day. And he put me in a different class than the Black laborers on the job, which he always said were lazy because they took naps at their lunch break. But they were taking naps because they were in school at night. And it's unfortunate that he felt that way, but he and I were still able to find common ground, even with his despicable views, to build a major building together. I think, you know, these days today, we don't have those kind of issues to deal with, thank goodness. But it's still subtle in microaggressions. So the feeling is still there, but I guess it's just not as in your face until recently. So, you know, it's to the point where just recently, Construction Dive did a 6-part article on racism and how it impacts construction, because Black workers were finding nooses on the job site. You know, this threatens legal liability because many companies have been sued and had to pay out large sums of money for hostile environments. But my more concern is the safety liability. We live and breathe safety in construction, but how safe is it if you're working on a dangerous part of a project and you have to depend on a team, and your team is racially divided, or they have microaggressions or personal biases against each other? How safe is that? So like, now is the time that we really, really need to come together and do something about this major divide. I'm noticing that clients of mine and owners are now trying to see diversity on their teams. We've been responding to a lot of proposals. In January and February, we responded to only 4 proposals, but since COVID hit, we have responded to 80. So I feel like I really know the trend of where owners are going. And what I'm seeing more and more of is that they want to see diversity. They want to see diversity inside of the companies. They want to see the diversity of who the companies hire as their consultants and subcontractors. So, you know, it's time for us to really start making sure that we do that. But, you know, it's going to be a little more difficult. I started my business 30 years ago with $1,000, an okay business plan, and a lot of passion, and we've been fortunate. But the coronavirus has hit minority firms a lot harder than it has hit majority firms, and it has hit women firms a lot harder. So we're going to have to work a little bit harder to help sustain these businesses and help them grow. And that's another trend that I have been seeing with the Fortune 500 companies, that they have been asking me on how do they help minorities gain the ground and not just break ground. So they want to see sustainable growth when it comes to minority businesses. So that's really why I came up with my 7-point plan. And the 7-point plan really addresses 2 things. One, the purpose of it is to decrease the economic gap that exists between minorities and majority firms and people. And two, to really give women and minorities an equal seat at the table. So, to really just cover it right quick, we have to first admit that there is systematic racism, there is unconscious bias to, gender, and try to start developing policies that remove that from our companies. Secondly, I think it's important that we start to promote the people within our companies are find minority and women that we can promote within our companies. Also, put on our board. I have recently, for the last 8 months, seen owners say, well, is there a diverse board? We want to know, do you have a diverse board? Because we don't want our solution to come from a monolithic, done in a vacuum. We want to see our solution coming from a group that understands all of America and not just one portion of America. Another very important point is that we need to start hiring minority firms as primes, first tier contractors. They have the ability to do it, but they rarely have the opportunity to do it. So it's important that we do that. And that we have minority goals for subcontracting, but they've gotten laxed over time. And we should really push to make sure that, we are really pushing for these goals because they can happen, but people have to be forced to make that happen. And the people are there to do it. I know that my company, McKissack, in every city we go in, we've worked to build minority capacity. Whether, it's digging a major hole and we start with one trucker and we help him with the next truck to the next truck so that he ends up with a business or she ends up with a business to go on to the next big job in that city as a business with 5 or 10 trucks, maybe 20 trucks. That's how we have to look at it. How can we increase the usage of these historically underutilized businesses? And then lastly, because of economic zones, we are now working in, underutilized neighborhoods. And these neighborhoods need economic development. And I just feel as we're there, we might as well use the people in that neighborhood, whether it's hiring laborers or whether instead of catering your food from your normal place downtown or in your neighborhood, cater the food from that neighborhood. But see how you can bring economic development to the community in which we are working in. So that's sort of the end of my 7-point plan. But in conclusion, I would just, say that, hopefully we're going to adhere to what we've learned in 2020 when it comes to humanity. I do feel that 2020 with the pandemic, the George Floyd moment, all of the weather disasters we've experienced, all of that was for us to get 2020 vision so that we can see 2021 and beyond. We're at a point where, you have to know where you stand. No one can no longer can sit on the sideline and be silent. Everybody has a position. The shades and the scales have been taken off of our eyes, so we know where we are and we know where others are. So now that we're there, can we build bridges to unite and work together to move our country forward? Because I believe that is the only way that we are going to see the economic recovery that we would all like to see. Thank you so much for having me here today, and I appreciate your time.
Daryl, sometimes I feel like we're on Hollywood Squares, with the Zoom layout and everybody's on there. And if we were, you get bonus points for the 2020 vision. It's the first time I've heard that. That was awesome. Thank you. I love your story about diversity. I'm going to do a screen share here and quick and talk while I'm doing that. But I grew up in a small town, Minnesota. And if I wanted to hang out with white people who said, yeah, you betcha, and talked about ice fishing and their pickup truck, I can find those people. I would much prefer to work with people who are different from me. Just saying. We could all think like that. It's not hard. Okay. Right now I'm screen sharing. I'm showing our lobby. This is our virtual lobby. It was created by our tech team. So thanks. Shout out to those folks. It shows our people here, but most importantly, this is where you can find out who's speaking currently. So you see there's Daryl's lovely photo. And if you click on the button below her name, that's her LinkedIn. You can connect with her on LinkedIn and find out more about her. This next panel coming up, we got 6 great panelists, and same thing. They got a little button below their name. Connect with them, say hello. This is the best we can do for networking when we're not live. So here it is. And you can also see what they're going to talk about, a little preview of that. So there you go. That's our lobby. All right. So folks, if you're on the next panel, show your video and unmute yourselves. Make sure that I can do that real quick here, just to update our PowerPoint. While these folks are talking, I'll show this PowerPoint a couple times just to see. Look at that. I've got everybody's name and where they work and their email address on here. So let me, so if you see that pop up, don't fear, it's just me. All right. So are you all ready to go?
Ready to go.
Okay. I'm going to bow out. I'll still be here in the background. If you need anything, you're having trouble screen sharing, do anything like that, say, hey, Todd, I need you for a second. But again, don't be worried if I change up your screen and show those bios real quick. Take it away.
Excellent. Thanks so much, Todd. And Daryl, thanks for that great opener for the session today. It was both moving and definitely insightful. So I appreciate your comments. Today we have a phenomenal board of industry leaders, a panel of industry leaders today with us. We're going to have folks do individual introductions quickly for a little bit, and then we're going to go ahead and take a look at the Chicago industrial market from a stats and numbers standpoint for a couple minutes, and then we're going to get into a lively Q&A discussion with the panel to really showcase their years and years of expertise in the Chicago industrial market. So real quickly, my name is Todd Steffen. I work for Colliers International. I worry about client success related to industrial capacity. So my job is to leverage 25 or so years of supply chain planning and execution background for companies like Walgreens and Newell Brands to now help our Colliers clients think about their future state industrial capacity from a distribution network standpoint and an industrial real estate transaction standpoint. So I'll turn it over to Karen, who can introduce herself, and then we'll go from there.
Hi, I'm Karen Lauerman. I'm President and CEO of the Lake County, Indiana Economic Alliance. And today I'm representing all of Northwest Indiana, which is Lake, Porter, LaPorte, Jasper, Newton, and Pulaski counties, along with our friends at Stark County. What we are is the natural eastern suburb of the city of Chicago and the Illinois market. So looking forward to letting you know what's going on in Northwest Indiana as it relates to the entire Chicagoland industrial and TDL outlook. Thank you.
Excellent. Caitlin, would you please come?
Sure. I'm Caitlin Sullivan. I work for Link Logistics Real Estate, which is an industrial operating platform wholly owned by Blackstone. Link has grown quickly through acquisitions of every size over the past few years, now operating over 400 million square feet across the country. I am on a 5-person team that sits here in Chicago, overseeing our portfolio in Chicago and Wisconsin, along with Rob Damerat, Ryan Hansen, Gigi Moylan, and Jack Tolchin. We work closely with the industrial brokerage community to work with tenants in the market, and our objective is to drive revenue for the portfolio through leasing and operations on behalf of the Blackstone funds.
Awesome. Thank you. Brian, why don't you tee it up now?
Sure. Thanks, Todd. Brian McKiernan, Senior Vice President with CenterPoint Properties. We're really investing on behalf of CalPERS, the California Public Employees Pension Manage the Midwest from development here. So everything from Texas up to Chicago, Wisconsin. CenterPoint probably is 80 million square feet right now, focused on the port and coastal markets.
Awesome. Renee, why don't you introduce yourself?
Yeah, sounds good. Thank you. Renee Sirk, I'm the Chief Operating Officer for GID Industrial. GID Industrial is a sort of a newcomer, if you will, to the industrial platform. GID is a privately owned firm that's been around for about 60 years out of Boston and doing industrial for close to 30 years. But now we've taken that experience and we are building a much more significant industrial platform. And my role is national, not just Chicago, but I do actually live in the Chicagoland area.
Excellent. Thanks. And last but not least, Jim, can you please introduce yourself?
Sure. Thanks, Todd. So Jim Martell, I'm the CEO of Logistics Property Company. We're the U.S. Vehicle, part of the Macquarie Global Platform of Infrastructure and Industrial. We have 7 offices across the U.S. where we're actively doing ground-up development. Just completed our last fundraise, and we should closing in on about $2 billion of assets currently in our portfolio. So we started this business about 2.5 years ago. So we've been on a tear driven by the demand for industrial. So we're very excited about being part of this industrial platform.
Excellent. Thanks so much. I'm going to go ahead and share my screen. We're going to jump into just a few slides on the Chicago market from an industrial perspective. And obviously it's been, a year of 2 different stories combined. If you take a look at the net absorption, 2020s in the yellow vertical bars there, essentially, great level of absorption in the first quarter, and obviously Q2 and Q3 had a slight pause, although we stayed positive on net absorption, which was great to see. When you take a look at the numbers with regards to new deliveries on construction, at 16.5 million square feet, that's powered some of the 8.6 million square feet of net absorption that you see overall in 2020 through the first 3 quarters. Obviously, as unemployment jumped up during pandemic times and is now settling back down, we saw a little bit of an uptick in our vacancy rate overall, up to 6.7% for the market. But if you look at where we came from a 12.3% high right there after the financial crisis, it's been quite a few years of declining vacancy rates, which has been great to see. If you take a look at infill, which is obviously a hot area of industrial, and I'm sure we're going to touch on that today a little bit, infill vacancy rates remain the lowest. And that really is not just a Chicago phenomenon. I see that across the country as I work with many clients that have national portfolios. Infill development is really trying to catch up with the low vacancy rates that the infill. As far as greenfield submarkets in Chicago, we've just sampled 4 of them here, and you see that the vacancy rates vary quite a bit, all the way from I-80 at 6.6% to I-55 close to 12%. Amazon obviously is a major occupier in the industrial space. Just an amazing year with regards to Chicago industrial absorption from Amazon, with 7.1 million square feet in Q2, 3.3 in Q1, and really it reduced a bit in Q3, but there was so much in Q1 and Q2 that's really not a surprise. And we'll talk about some of the size of those facilities here in a second. But it's great to see that we could still have the amount of net absorption in Q3, overall, without Amazon necessarily playing a large role in that last quarter. Here are some of the largest transactions in the Chicago industrial market. Obviously, Amazon, made the papers with the 3.8 million square foot facility. You don't often see a lot of those. But here are some other notable 1 million plus square foot deals, leases that were signed as well. It's good to see the mix, the blend of spec and build to suit. And take a look at the active projects. You know, there's 20 million square feet or more of build to suit deliveries and about 7 million of spec. Obviously spec, you know, in March, April, May was a little bit more tentative and there were a lot of feet on the brakes, but we're seeing the spec development really come back strongly. And it's like I said, it's a good blend, but build to suit is really, you know, a major source of net absorption in the market. And then this is a very promising slide. If you take a look at just, you know, most of the unleased space is stuff that's been recently developed and brought to market. You see most of the stuff that was developed in, you know, 16, 17, 18 even, that's, you know, very high percentage of space being leased already. So it's you know, shows well for the new product that it's being leased, quite a bit of pre-leasing activity as well. But good to see that, you know, that newer product is needed in the market. So I will wrap up there, and we're going to go to begin our Q&A. Let me stop sharing here. Okay, great. And our first question is going to be for Jim and Renee. Jim and Renee, I'll direct our first question to you. Jim is the CEO of LPC, a company with over 20 million square feet of industrial product under development currently across the US. And Renee, as you build out an industrial investment platform at GID Industrial with national focus, can you both share with us your perspective on how Chicago fits into the national industrial investment and development picture, please?
Now, I can start, I guess. You know, Chicago is very critical to the entire logistics network just because of where it sits within the transportation model for everybody. All the class 1 railroads, all the major highways sort of blend into Chicago. So very, very critical from a logistics perspective. A lot of the product that comes from the West Coast ports, you know, deadheads here through the UP and the Burlington Northern railroads, as well as coming out of Canada. When we were building the Ridgeport Logistics Center in south of Joliet, the main line between LA Long Beach and Chicago, just on the Burlington Northern alone, there were 80 some trains a day bringing containers into Chicago. So very critical. Chicago plays a very critical role in the overall logistics model for the U.S.
Yeah, and I can jump on it from the sort of the investment perspective, right? So if you're looking at a national platform, you don't have to be in Chicago, right? Technically speaking, you don't have to be in any specific market when you're building a national platform. But Chicago is interesting. Chicago, depends how you look at it. You can consider the largest industrial market in the country. When you want to make it second, you can sum Orange County, Inland Empire, and LA, and then suddenly Chicago becomes second. So it depends how you want to sell it. But it's a very massive industrial market. It's a very established industrial market. And it pretty much anybody who is a significant investor in the industrial real estate space has presence in here. Now, one of the reasons why people have presence in here is precisely because of the scale. People out there trying to place money. And if you don't have presence in Chicago, your job gets that much more difficult. Now, you know, I've been living in Chicago since 1996. So I consider, although probably from my accent, you can tell I'm not from here, I consider it my hometown, and I've been defending Chicago for decades for people who said that you don't have to invest here. But, you know, at the same time, if you think as an investor, what you're buying the present income, and you're buying the potential of future growth, right? And that is the area where Chicago, compared to some of the other markets, has lagged. Everybody in the industrial market nationwide is feeling really good about the property segment they picked, because industrial is the darling of foreign capital, industrial is the darling of domestic capital, and more groups are essentially jumping into that bandwagon and pushing prices up Amazon obviously absorbing space across the country, pushing rates up. So it's been a good investment. But thinking about it from a future perspective, what we always weigh is what is the prospect for rent growth. And you do see rent growth in some of the southern states and markets to be outperforming. The other question we always have on mind is, and this is not news to anybody, is property taxes. Now, we focus more on the infill product, not the million square footers, which can be in Joliet or other places. And the argument I make in Boston is, well, if you want to play the infill game in Chicago, you have to be comfortable with Cook County. Because if you say we are not willing to be in Chicago, but we're not willing to be in Cook County, you've eliminated vast majority of the infill market. And those are the kinds of debates that we are having. We were just a week ago, we were making an offer on an investment, and these are the kinds of questions that do come up. So I feel positive about the Chicago market. I think it's going to do well, and it's a very significant portion of the investable stock in the United States. But those are the questions that are going to come up more and more. How does it compare relative to other markets? Because I don't have to invest in Chicago, and there are some investors who don't.
Excellent insights, Jim and Renee. Thanks so much for giving us the perspective from a national viewpoint on Chicago. I'm going to turn to Brian. Brian, with over 14 years of experience at CenterPoint and given CenterPoint's long history of industrial development, acquisition, and management in Chicago, can you give your perspective on how you're looking at build-to-suit versus spec development at this time? And what are some of CenterPoint's favorite submarkets for future development or growth in acquisition?
Yeah, thanks, Todd. I think with CenterPoint, we're trying to be balanced. I think we want to have a fair amount of spec development, also try to manage that with some build-to-suit. So I don't think we're probably as far out on the risk curve as other developers or landlords would be. I think we're really focused on, I'd say, 3 markets. The Joliet market, I think we have a good track record down there, keeping our buildings extremely flexible. The O'Hare market, I think that's, maybe a little bit of that infill sort of redevelopment type strategy, and the Southeast Wisconsin market. I do think on the spec versus build to suit, as you get some of these e-commerce users and the requirements are changing, and there's a definite spec that each user prefers. So I think it's getting a little bit difficult to do a generic spec for everybody, but obviously as markets tighten up, that there's a more line to take what's there. So I think a balanced approach. Sorry, Todd, I think you're muted.
I'm also going to unmute. Caitlin, I'm going to turn to you now. Sorry. With over 400 million square feet under management across the U.S. and 34 million square feet in Chicago, please provide us your perspective on leasing activity and rent rates on existing industrial product across the Chicago industrial market.
Sure. As you noted in your slide, and no surprise to anyone here, there was certainly a sharp drop in momentum in March and kind of quiet throughout the second quarter. But any customers we were talking to then were really focused on prioritizing flexibility and understandably slow playing decisions to see how some of this stuff played out. But I would say that, despite everything that's been going on, the industrial fundamentals have stayed strong. And so, Link and our peers, for the most part, have not experienced a dip in rental rates. Activity is really coming back pretty strong. I think in the last few weeks, we've seen it get pretty busy. Customers are starting to talk about longer term plans again. So I think we're approaching pre-pandemic levels. There's obviously still a lot of question marks in the air right now. Just like Chicago is a diverse city, the industrial market is one of varied submarkets. We've already talked a bit about infill, and I would say we've had the same experience. Our infill submarkets have really shown the most value. There's been a ton of activity on our smaller spaces in O'Hare, Central DuPage, and the near south suburbs. despite Renee's comment about taxes, which is certainly an issue. But access to labor, proximity to customers are continuing to be a driving force for our customers in their site selection decisions. The other thing I would note is that our average tenant size is about 100,000 square feet in Chicago. So again, kind of the smaller spaces. 70% of the deals that we've done this year have been sub 100,000 square feet. So, the activity in those smaller size ranges is thriving, and all the new development that we've been talking about, really doesn't cater to those customers. So I do think that we expect rents to continue to grow for the smaller size ranges going into 21.
Excellent. Thank you so much. Karen, as the CEO of Lake County, Indiana's Economic Alliance, and given the proximity to Chicago as the suburb to the east and over 150 projects underway there, please share with us your thoughts on Lake County, Indiana's role in the Chicago industrial market.
Well, thank you, Todd, and thank you for allowing us from Northwest Indiana to be on the panel. It was good to see Southeast Wisconsin in the mix of your data, but I do have to comment that Northwest Indiana, although we are typically in the Chicago MLS and DMA area, most people consider us in their research with Indianapolis, but I do have to point out that Northwest Indiana is about 150 miles north of Indianapolis. So we are your eastern suburb of Chicago. That's that natural progression that's going on with companies like Meisner Group, Clayco, Holiday Properties, Becknell. We have a laundry list of Crow and Arco are building currently in Northwest Indiana. In fact, I know Meisner Group is working on a significant project in East Chicago right now. East Chicago is probably as close to the border as you can possibly get, along with our East Chicago Gateway Logistics Center, which is going to be about 3 million square feet under roof, starting with 1 million square foot spec building immediately adjacent to the Gary Chicago International Airport, where UPS just added a delivery route to that particular airport. So Northwest Indiana is not seeing the same trends about vacancy and lease rates. Our availability for infill, our availability for green space development all exist in Lake County and the whole of Northwest Indiana. I'm only speaking to my particular county, but having sipped the regional Kool-Aid for many, many years, Northwest Indiana as a whole has opportunities with multiple regional airports. Ours just happens to be the third airport of Chicago with the relationship with the Chicago Airport Authority. But as you mentioned, Todd, we have a couple of things going on, about 150 projects in Lake County right now. So that uptick that we're seeing hadn't dwindled with COVID. It actually stayed consistent in the early stages and then grew significantly as companies reevaluated on their strategic moves, their expansion, and of course, Amazon and those e-commerce opportunities. And Renee mentioned in his comments about property tax. The difference between Illinois and Indiana is that Indiana has property tax certainty, which means we are constitutionally bound to a 1% for residential of assessed value, 2% for multifamily, and more importantly for this particular conversation, we are capped at 3% of the assessed value. So in difference to our neighbors to the west, the north, and to the east, we have tax certainty. It's within our Constitution. So Renee, when you're talking about the value of the Chicagoland market, I think it's also best to look at Northwest Indiana. But even more significant than that, that was mentioned earlier by Deryl, is the opportunity zones in the new market tax credit areas for work in the diverse communities, our more industrial urban cores that need assistance. In Lake County alone, there are 15 opportunity zones for investment opportunities. One of them is the East Chicago Gateway Logistics Center that's next to the airport, but all of our counties in Northwest Indiana have at least one opportunity zone. We've been very fortunate working with the state of Indiana to accomplish that mission of looking at the urban industrial core for infill, taking those aged industrial facilities, turning them into state-of-the-art facilities for new manufacturing and distribution. So we've been very fortunate here in Northwest Indiana. And just as a point of reference for those that don't know Northwest Indiana, how close we are, we actually have a group called Digital Crossroads, very large data center that took over the State Line generating facility, which sits on the Indiana border of the Chicago Skyway. From my home, from my home in Highland, Indiana, I can get to downtown Chicago, Northwestern Memorial Hospital, where I used to work in that vicinity, within about 30 minutes. So when you're talking about other suburbs of Chicago, we love all of you, because a strong Chicago and a strong Illinois is a strong Northwest Indiana and Midwest. But we always look to that. So thank you.
Thank you, Karen, for that perspective. It's very regionally, it's great to know about the development underway there. Let's see here. I'm going to open this question up for different folks on the panel to weigh in on. And I'll start with Karen. I'd like to get your perspective on the debt markets and cap rates and expectations for valuation for the Chicago industrial market moving into 2021 and beyond. And Karen, if you have thoughts on that, we can start with you and then move to Brian.
Sure. And just briefly, the cap rates, the triple net leases, they're all very different than the Chicagoland market because of the business and tax certainty in the state of Indiana. So when you're looking at a triple net lease in Illinois, it's very different than Indiana. We've got wonderful brokers that we deal with, but this is the opportunity. And when I mention the difference in Indiana versus Illinois, this is one of those examples. We're seeing on average about $11 to $13 per square foot for good Class A industrial. We're seeing a good acreage price for green space development. So when you're looking at that, but I do have to say that our bankers are being cautious over all the financial institutions, that there's might be a little bit more red tape for certainty of repayment on that debt. But in Northwest Indiana and Indiana as a whole, the business climate affords a better rate on your investment, better quick return.
Excellent. Jim, would you share your perspective on that?
Sure. We just completed our appraisal review for all our assets, and I would say across the board, we had compression anywhere from 25 to 50 basis points from last December. And obviously credit and lease term, but yeah, we're seeing continued compression in those cap rates. And so we expect capital flows to continue to drive that. And with interest rates, with the 10-year treasury as low as it is, we're still seeing, even at a 4 cap or 4.5 cap on a deal, it's 400 basis point spread over the 10-year, which is unprecedented returns.
Excellent. Brian, do you have some thoughts on that?
No, I think I'd echo that. I think there's I think term and the quality of the credit is really getting, sort of all-time low cap rate. I think the B product, or you're seeing indoor, maybe 60s roll off, you're seeing, maybe less compression. And so, we're focused on managing to that. And then to the point, we're more looking at the corporate debt. And when you see that, I think you're seeing, that what Prologis just issued the other day, kind of all-time low rates. So I think hard to say anything but echo what Jim's saying.
Excellent. Renee, do you have any thoughts from a national perspective on that?
Yeah, as I mentioned earlier, industrial is the darling and of all property types, followed by multifamily, and closely followed. But probably about a year ago or two, it surpassed in terms of the interest on the institutional side. What that does, obviously, it creates capital flows, and therefore it will lower cap rates. Cap rates have been coming down quite a bit, but the surprising difference may be because, technically speaking, maybe you're still inside a recession now. The cost of debt, what we were underwriting, let's say February or January of this year versus now, is probably 50 basis points less than it was then. So that has helped initially maybe juice returns a little bit, but now that has turned into paying unprecedented prices. When you're going to go and buy a building, you will probably have a very difficult time to comp yourself out. And on your next deal, your best comp is probably going to be the building you just bought yesterday, because that was the record price, and now you're justifying a new record price. So I think that's going to be a little bit of the struggle. We have all-time high rents and all-time low cap rates. Well, when you take those two numbers and you divide them into each other, you end up with all-time high prices, and that is absolutely true across the country.
Yeah, Renee, thanks for that perspective. That actually tees up the next question well. And again, I'll open it up for everyone on the panel to comment, but please share your perspective on how companies are underwriting their deals in the current market, given the high cost of labor and land. And maybe we'll start with Caitlin on that.
Sure. I'll let the others talk more about the impact on development, but for us, labor costs and availability are always top of mind, because it's the top of mind for all of our customers. As I mentioned earlier, it's a huge priority in their decision making. So, local labor market, how it's performing is carried into our underwriting on existing assets, as far as assumptions on retention of tenants, leasing velocity, downtime, as well as the impact on growing tenant improvement costs. So we see that continuing to be a hot topic in both leasing and acquisitions into next year.
Excellent. Brian, do you have some thoughts on that?
No, I think I'd echo everything Caitlin said. So again, I think that's sort of CenterPoint's position as well.
Got it. Jim, and
the interesting when you look across the country. So Inland Empire has had almost average for the last 9 years. 2011, I think, was the study. It has averaged almost 9.5% rent growth annually, and it's obviously had to, because land prices have gone from $4 or $5 to $50, $60 in some cases. So rent growth is critical to keep up with the escalation in land prices. Commodity prices across the board now are starting to really move. They dropped in the first quarter, into the second quarter a bit, but now with the resurgence and demand, lower production because some of the plants slowed down. They're trying to catch up on their pricing, so that's starting to impact us. So the combination of things, obviously low interest rates help balance some of that out in the short term, but it's critical to watch that price per pound. If you're a long-term investor, you don't want to get caught with too high a price per pound when rent starts to drop.
Excellent. Renee, do you have any closing thoughts on that topic?
Well, I mean, it's absolutely true that price of everything, if you will, is going up. And what has made all of this possible is the cost of money. Right? The cost of money is much cheaper today than it was a few years ago. It's much cheaper today than it was at this time last cycle. And we underwriting. I mean, we just underwrote a deal in Chicago. I think it was like $160 a square foot. We underwrote a deal in Atlanta last year, which was about $150 a square foot. Even in Orlando, we underwrote a deal that was about $150 a square foot. So what that has allowed, it has allowed to absorb some of these costs. If you think about infill industrial, for example, one of the reasons why there's so little of that product that's modern, right? Everybody says it's very difficult to find land sites, and 100% that's true. But the answer is it's not difficult to find land sites. It's difficult to find land sites that work at a certain price. And when those buildings used to cost $60, $70, $80 a foot, it was not possible. Now, when buildings like, we're starting to see $200 a foot price in markets like Phoenix. So when you're starting to see those kinds of prices, suddenly a lot more development starts to make sense, and you can absorb the rising in material costs, labor costs, so I think although prices are rising, construction costs are rising, I don't think it has gotten to a point where it's impacting the appetite of developers to build.
Got it. Yeah, definitely. You know, it's interesting. I was just on with a number of folks the other day, and obviously industrial focused, and they said this is the absolute best market they've seen in their careers. And the topic of truck terminals came up, given the transportation congestion that's underway in the U.S. infrastructure, and just the difficulty in moving freight over the past few months for sure. But it's been a long coming trend, you know, with over the road driving distances shrinking, given hours of service and driver shortages and that kind of thing. Just throw it open to the group. What are your perspectives on truck terminals? Because the economics sometimes are really, you know, tough to look at on a per square foot basis, but obviously, you know, those terminals get priced out on a per door basis for leasing in many cases. So just curious about truck terminal, either construction or leasing activity from what you're seeing within your markets or portfolios.
Yeah.
You know, a lot of the Amazon buildings, in essence, are just, you know, are small buildings with attached to them. In the case of their van terminals, their parking buildings. Our building in Kenosha, Wisconsin, 750,000 square feet. I think they're using 100,000 for material handling and 650,000 for van storage.
Wow.
And so you look at across the country, Amazon will take 100,000, 150,000 square feet of building area and want 20, 30 acres of parking.
We're seeing the same thing in Northwest Indiana because of our lower lease price for those types of truck terminals. We don't have communities that understand necessarily truck terminals, so there's an education component that we're going through, but at the same time we're finding those aged industrial facilities that did have large scale parking areas ideal for those truck terminals because they're out of the way, they're not near the residences, and it's an opportunity to capitalize on that space. And if it's a lease or if it's an ownership issue, there's an opportunity there. And to Jim's point, Amazon does the same thing in Northwest Indiana with their last mile delivery station, so to speak, a lot more parking, and we're still looking for more for them. And we anticipate all of the e-commerce to be growing. But with our labor force that Caitlin mentioned, you know, it's always looking for labor force. Northwest Indiana is a little different because our labor force is our compensation, and our workers' comp insurance is also lower. So we do have a little bit of an advantage when you're talking about a workforce. So putting that together with truck terminals and making sure there's space for people to park and go, that's always a challenge, I think, for any community from an economic development standpoint.
Absolutely. Brian, Renee, any comments on it?
Yeah, we're actually selling a pretty large terminal portfolio now nationally. I think we're seeing extremely strong interest, extremely strong pricing. It's located throughout the country, so pretty diverse. I think from the development standpoint, and we've done a few of those, I think they're one of the few Chicago assets that you can really push pricing, and there's a barrier to entry. And so I think that's one of the things we like. The replacement cost generally tends to be excessive, and a lot of communities don't want those. So I think, you know, when you have one, there's still value there, and you can push pricing and push value.
Got it.
Yeah, it's not a property subtype or segment of the market that we are really chasing at this point. We're trying to understand a little bit better. Trucking is going to be an issue going forward. If you think about the average age of a truck driver is 55 years old, and their life expectancy is about 60. So the math doesn't work. So one thing to sort of think about is what, you know, autonomous driving and trucking is going to have to come, and it's going to have to come sooner than people assume. And so that's where we are trying to, at this point where we are, we're trying to educate ourselves on what, you know, what our house view is on this and how we actually think it makes sense to invest in that segment. But right now it's not a target.
Caitlin, any thoughts on truck terminals in your portfolio?
No, similar to Renee, it's not something that we have a lot of. You know, certainly hard to replicate, and will be a growing demand going forward. So something I'm we're interested to learn more about, but not something we have a lot of in our portfolio currently.
Got it. There's been quite a bit of discussion today about Amazon and their network, and just to give you a few stats, I study the Amazon network quite often, and back in January of 18, we were looking at 400, a little bit over 400 facilities, 150 million square feet. But the key number is this delivery stations, Jim, as you mentioned, it was only sitting at 120 delivery stations at that time. And since the last 3 years have taken place, they've skyrocketed to over 900 facilities, 330 million square feet, and over 450 delivery stations, which seems staggering, but not given the plans that they have coming up in 2021 to add 50% more capacity to their network than they have today. So it's remarkable when you start talking about those last mile facilities, numbering 500. And then, let's say it gets to 750 last mile facilities across the country. It's just an incredible factor to account for in any of your planning, and kind of understanding where those last mile delivery stations are. And, we had 3 of them, I think 4 years ago in Chicago, and we thought, okay, that's what we're going to have. And I think now we have 11. So it's pretty incredible, just the rapid pace of growth there. I'll throw it open to the panel. Any final closing comments that folks want to offer our audience today? And again, we appreciate everybody being with us.
Well, Todd, I'll go first. Challenging times call for creative measures. And I think from an economic development standpoint, and in light of what my colleagues on this panel have said, it's incentives do matter. We know that from a community standpoint, be it infrastructure or tax abatement or tax increment financing, we know we have to be creative to assist you in drawing your business in. But one of the markets I don't think we touched on, I know we talked a lot about e-commerce, cold storage and food processing and distribution has been very significant for Northwest Indiana. And right now, approximately 1/4 of those 150 projects that we're working on are food distribution and cold storage. So I think that there is something to be said tying into that e-commerce, the pandemic and some of those other things that have fallen into place. But my last comment is we appreciate being part of the Chicago market in Northwest Indiana, but we just have a few other advantages. We're not going to come pilfer your companies, but sometimes when we have companies knocking on the door, we're not going to hesitate to open it for them. So thank you all very much for allowing us to be part of this panel, and kudos to my colleagues for all of the information that you've shared today.
Thank you, Karen. Anybody else? Any closing comments?
I mean, I'll just say that, this has been a very challenging year for a lot of people. I think we can consider ourselves very, very lucky that we are in the one segment that's actually benefiting from what's going on in the world. And, I think next year is going to be better in many ways, but at the same time, on the industrial side, it's probably going to be a little bit worse because the market is going to be even more competitive. There'll be even more players coming, and cap rates are more likely to go down than up, and rents are more likely to go up than down. And so, get ready for an exciting 2021. That's my plan.
Excellent. Thank you, Renee.
Yeah, I'll just echo Renee's comments. Thank you, Todd, for hosting. I think, in life and getting through these next couple of months will be interesting, but in industrial, I think we've got a lot of exciting things moving forward, and just very appreciative of our peers and our industrial brokerage community and customers working with us as we head into next year.
Excellent. Thanks, Caitlin.
Yeah, same thing. I think it's an exciting time in industrial real estate, and looking forward to the next year and hopefully continue this, development and investment environment.
Thank you, Brian. Thanks for being here. All right, Todd, I'll turn it back over to you. Appreciate you teeing up the panel and definitely structuring this. Thanks to the Real Estate Journal's team, by the way, for giving us this forum to share information and thoughts with each other across the industry. So have a great day, everybody.
Todd Steffen, we appreciate you. Great job moderating. You're going to take my job away. All you all have gotten so good at Zoom calls, I'm going to be out of work. I'm going to have to go back to
I need the
doing
headphones, though.
These are, these are nice. I got to tell you, I splurged and bought good ones. It doesn't create a feedback loop ever, and it might look a little dorky, but I love them. So I'm not trading them in for anything.
Reminds me of
I'm going to babble here a little bit. Yeah, right. I'm going to babble here for a second while this next panel comes on. So if you're on the next panel, turn on your video, turn on your audio. Don't forget to mute yourself when you're not talking, but for now, turn your audio on. Do a quick screen share here. I'm going to show you our YouTube channel. So this event and all of our events lately have been on our YouTube channel. You can see this. This first section here, you see events and my goofy face saying hello. And these have events all over the Midwest, all over, and Texas. So if you want to find out what's going on in industrial in Texas, there's an event on here. You can go back and look. This next section. This is my show, Power 30. We got a new episode dropping soon. It's going to be fun. And then at the bottom, news, events, and shorts, you'll see little clips. So there's a couple things that I think Todd Steffen said and some other people on that panel. I'll probably clip those out and put those down here. So this is where you can kind of see some highlights. You'll see that on our news page as well too. Let me just get this last panel up here. Whoop, I'm pushing the wrong buttons. Screen share one more time. Here we are, construction, design, management, leasing trends. I'm going to turn it over to our moderator, Peter, if you're ready to go. And again, just like last time, I'll be here. If you need any help, just holler. See, it's Peter, you ready to go? There.
Appreciate that. Thank you. Good morning, everyone on our panel here this morning and everyone joining us remotely. It's good to be here. We've got a great topic today, construction, design, management, and leasing trends. We've got a superb panel that has seen and heard almost everything over the years and is sort of the future of industrial. So we kind of want to get right to it with some introductions here. If you guys can go around the room and kind of introduce yourselves, your companies, and what you do in industrial.
Sure, I'll jump in. Thanks, Peter. My name's Cameron Treffery. I'm a principal with Ware Malcolm. We're a full-service architectural design and engineering firm. My role with the company is I oversee Chicago, Oak Brook, and Washington, D.C. Fun fact about us, we will probably eclipse 80 million square feet of industrial building design this year. And we're very proud of that. So looking forward to this panel. Thanks.
I can go next, Peter. Eric Pitcher, Regional Manager of Economic Development with the BNSF Railway in Chicago. My territory includes Illinois, Wisconsin, and parts of Iowa and Kentucky. I'm one of 10 regional managers within the company. We're a Class 1 railroad, and probably for Chicago, one of the most significant things is we handle roughly half of all the containers that come into or go out of the Chicago market by rail.
Sure, I'll go next. Kevin Scott, Vice President Investments and Development with CRG. CRG is the development arm of Clayco, and currently we're building approximately 10 million square feet of distribution space nationally. We've got regional offices in the Northeast, the Southeast, the Midwest, newly partnered on the West Coast operation, and we've got a fast-growing Chicago office. So very excited to be here.
I can go next. Mike Larson. I'm with Insight Real Estate. We're a privately held national industrial build-to-suit development firm based out of Oak Brook. And in my role, I head up our development operations across that asset class nationwide.
All right. Well, thank you all for those intros here. You know, we've had some really great discussions here over email and in person on Zoom and calls and discussing trends in industrial real estate. There's a lot going on right now. I know that COVID is kind of a hot button, so a lot of what we talk about has been shaped by, you know, what's happened in the past, 9 or 10 months here. But in addition to that, I mean, we do have just regular changes that occur within industrial that are ongoing, and it's obviously a booming asset class with a lot of room for creativity. So today, we're going to share all of our thoughts on, where industrial is and where it's going, in the near term, and then, thinking forward into the future, kind of where the opportunities are and what people are asking for in buildings for both users, owners, developers, you name it. So, Kevin, if maybe we could start with you, and we talked about spec build to suit projects and kind of current building specifications. Maybe we start with kind of how those have changed recently and what you're seeing.
Sure, would love to. I think we did miss David on the intros. It shows that his Zoom is connecting too, so I don't know if there's connectivity issues, but
yeah, we'll.
All right. Well,
yeah, when he gets on, we'll do an intro for.
Yeah, I can kick it off. So the spec build-to-suit conversation. We could talk for a full hour on this alone, and there's a bunch of different ways that we can go. But I kind of break it into three main parts, which is building specifications, differences between the two, and the trends that we're seeing there. The locations of these buildings, and then. Kind of a unique thing that doesn't really get talked about too much is, from a tenant perspective, what is the investment time frame that I'm solving for here? So getting back to the first question, the big question is, what are these buildings looking like, and the differences between the two? And I got to say, on a speculative basis, developers, ourselves included, sometimes who are guilty of maximizing a site plan, putting the biggest rectangle you possibly can to the detriment of the functionality of the building. Something we're seeing is much better site plans across the board, both what CRG is able to deliver and our competition is able to deliver. And part of that, from the first panel, you heard how frothy the capital market is. And with that, when you're underwriting these deals, you need to be underwriting top level rents. Much of the time, especially in an O'Hare type deal or a prime I-55 deal, you're underwriting at peak rents, if not peak rents with some kind of growth multiplier, depending on how far out that first lease starts. So you're seeing much better site plans. That includes deeper truck courts, that includes trailer parking away from the building, energy efficient interior and site lighting, heavier auto parking, and heavier base power that is expandable based on a tenant work letter. And then spec office. Spec office and spec building right now is standard 2,500 or 2,500 square feet, plug and play option, with an expansion plan in place. Seems to kind of be the going rate and included in shells these days. How that differs with the build-to-suit timeframe or build-to-suit projects is, these infill sites, there's low vacancy. The cost to redevelop is super high, as was mentioned on the first panel. So you're seeing the build-to-suit opportunities where these deals take, 9 months of corporate planning and then 6 months of, site selection and lease negotiation, and then another 9 months of construction, 9 to 12 months of construction. You're seeing the build-to-suits go further out. So the scale is larger as well. And in these larger deals, they're making longer term investments. So you're seeing, where 24 months ago, we saw kind of a lack of deals getting done in I-80 where everybody's kind of playing wait and see in late cycle. I don't want to make a 10-year commitment. I don't want to make a 15-year commitment to a lease. I don't want to make this massive, $60 million, $100 million supply chain investment because I'm not sure where the market's going to go if the bottom comes out. I think one of the tailwinds of, the past, 12, 18 months is, I don't think people are too worried about interest rates bumping up anytime soon. So those long-term investments are coming back into fashion. And with that, you're seeing all those things I mentioned with the spec building in terms of building attributes, but you're also seeing, since they're larger sites, larger buildings, more bulk type distribution centers, you're seeing better truck queuing, site security, floor flatness, because these guys are putting a lot of money into material handling equipment that can even, match the cost of the shell at this point. Some of those automation and robotic systems are so advanced. And then, long-term maintenance items. So full concrete truck courts, different landscaping packages, with the thought of, hey, this is a 10 to 15 year corporate investment. They're thinking smart about it and thinking about that year 10 of the lease and what their, all-in rental expense is going to be.
Yep. Kevin, if I could jump in, I like your comment about better site plans. I think that we are definitely seeing the development community adopt that mindset a little bit. And one of the biggest things that we see, and you touched on it, was the truck queuing and actually planning for a guardhouse location on a speculative building site. That's especially true with the big box stuff, right? That's something that we didn't used to see a lot of. You'd slam the building right up against the access road, one double loaded row of parking and no truck queuing. That's not the case anymore. The big box has at least 400 or 500 parking stalls at the front of the building. If it is speculative, we want to have a contingency plan for 2 tenants. We always want to go for 1 tenant, but plan for the worst, right? So there is planned access to get autos around the truck court and up to the north end of the building, to the other end of the building, separate from the trucking. So that's definitely something that I think we're seeing a lot more of.
Now,
yeah, and I didn't. Sorry, Peter. One more thing that I didn't mention is, it's clear heights. I think going 40-foot clear on a speculative basis 3, 4, 5 years ago, maybe on a major bomber on a building, say Prologis was going to hold long term, or a REIT was going to hold long term. That's more the norm. I think if you're over 350,000 square feet on a speculative basis, the base plan, the go forward plan, is to go to 40 feet. And if not, it's the exception at this point.
Yeah, I agree. That was build to suit. 10 years ago, we did some 40-foot clear buildings as build to suits, and we weren't seeing even any 36 in this market in the Midwest. 36 was the last couple of years, and definitely is 40. That's the standard now. And then that brings up the rest of the product. So anything even smaller than that is looking at 36-foot clear, and rarely are we seeing 32-foot clear buildings anymore. It's got to be a pretty small infill building that we see 32 clear.
Are we seeing these investment underwriting timeframes here in the last, really 2020, let's call it, and into 2021 now, taking a lot more time on the spec and BTS side, or is it business as usual? We're just changing specs around. Are people being more careful? Are they taking, advantage of kind of a bit of a, I don't want to say slowdown in industrial, but just in the economy in general, to kind of really plan these buildings out a little bit better? Are people getting pickier with their costs and what they're putting into these buildings? I think that's something that we want to know.
I mean, I guess, Peter, I can jump in. This is Cameron from the design perspective. We are seeing really high demand, and speed to market is still critical. So maybe people stopped and took a breath in March and April and just kind of waited to see what the heck was going on with the pandemic. I think it's normalized a little bit. People are used to working in this environment now, and it's full steam ahead. People still want to get this product up and out of the ground as fast as they can.
Yeah, and not to hijack the conversation, but from a developer standpoint, it's more of a conversation or a process of stomaching the cost at this point. I mean, you know what you have to build. The land price is going up because of competition and because of low vacancy rates. And frankly, there's just a lack of land sites in prime core markets. So a lot of the process is, all right, you know what you got to build. It's 20, 30, maybe even 50% higher than the last go around when you put up a building. You're underwriting at rents you haven't underwritten before. The building is costing more than you've ever seen. And you've got to assume that, guys are going to pay that $150, $160 a square foot. So I think once you get past that, it's still the same process, and it's still, the same construction schedules and same trades, maybe a little bit better attributes, better site plans, but that's the main hurdle at the end of the day. It's just getting comfortable with your assumptions.
I can jump in here for a second.
David, now that we got you back here, a quick intro.
Yep. My name is David Michael. I'm with Peak Construction, project executive over here. We are a design build firm, been in business 20 plus years. Experiencing a lot of growth here in the industrial segment is what we're here all to kind of talk about, and kind of echoing some of Cameron's descriptions of, design trends we're seeing is definitely everyone wants more trailer parking if we can have it. And a lot of things we're involved in very early on. We're usually quarterbacking and handling traffic studies and seeing how the sites can lay out, as everything usually comes back to dollars and cents, and truck queuing and more educating the local municipalities, because you get a lot of resistance of, how the trucks are going to impact the local traffic. And then even as it relates to truck terminals, jumping in, we're more educating the local markets because they've seen a lot of resistance. They don't want all those additional trucks, in their backyard or in their neighborhood. And, some projects we're pricing up off-site improvements with traffic lights going in, added turn lanes. And that's one of the things that we, are pricing up more and more as these things come out. And I'm sure Michael can speak to some of that as well, from a developer standpoint.
Have you seen the municipalities respond to a lot of the logistics issues in terms of the high demand for the logistics warehouses, the traffic that goes along with them? We've had a huge uptick in the last year in this market, and with spec built to suit, obviously in particular, the municipalities used to kind of welcome me with open arms a few years ago, and now it's all about the traffic study, the residents, and the congestion and the traffic patterns. Has anything changed, or have you found that they're starting to sort of soften up to that concept that this trend is here to stay? I get this question is for everyone as well too.
Yes, I mean I would echo everything that Kevin and David just mentioned with regards to some of the design and as far as the traffic goes and staging and queuing and the concerns with the community. So we're, with what we do, we're purely a build-to-suit developer. We don't develop on speculation. So we at least are fortunate that we don't have to guess right. But with regards to our clients understand that. They understand they want to be good stewards within the community, and we take these reports and try to work with these communities that come up with a reasonable approach that meets our tenants' requirements, at the same time being respectful for the community, because obviously these projects, there's a long-term investment, and these folks are going to be there for a while. So we're seeing that. Obviously, that's adding cost with truck staging areas and all the site requirements that we talked about, and trailer staging and less FAR, more land, more expense. But just to echo what Kevin mentioned, obviously rents are getting pushed because of the increased scope and the construction costs, but we're not seeing any hesitation. Our clients understand that is the cost. That's the cost to do business. They all realize that they need these facilities. And one thing that I think sometimes we forget about, because we're so concerned about the real estate aspect of it, is the real estate cost component of these facilities is a tiny sliver of the overall operational cost of these facilities. So while we're seeing costs and rents getting pushed, we're not seeing any pushback from our clients.
Peter, if I could add to that, from an offsite development perspective, what we're seeing an awful lot of is I think a little bit more robust planning and development of infrastructure, particularly road infrastructure around developments. Two examples I can think of around the Joliet area are the Hopewell Road Bridge, which is finally gained approval for construction, which will provide a direct access to Interstate 80 to couple with the direct access that entire development right now has to I-55. And the public comment period right now for the reconstruction or construction of two interchanges down in Wilmington at Ilion Logistics Park 55. You probably remember initially when CenterPoint developed the logistics park in Elwood, it took several years for the road infrastructure connecting it to I-55 to be completely developed. Now we're trying to compress that time frame. By we, I mean all of us collectively are trying to compress that time frame so that the public sector infrastructure is there in time for the real estate related development, in time for all of our customers. So I think that's something that's really benefiting us all at this point.
Yeah, that's a good point there.
One thing I wanted to mention about opposition from municipalities and residents is that in our infill sites and areas where we're coming into a maybe smaller site, maybe it's a 200,000-300,000 square foot building, neighboring residential, our biggest concern we are seeing is noise. And how are we going to, shield the neighbors from the truck traffic noise more so than the actual trucks on the road. That's a component of it, but we're trying to find creative solutions for mitigating the noise.
You know, I guess on a related topic here, we've talked about transportation trends, you know, rail, and Eric, we were going over this yesterday on the phone here, in terms of, you know, what rail logistics is and how it's evolving. We've got electric trucking that's kind of the darling here that's on the horizon. And speaking of noise too, I mean, there's that component of it as well. What can we say, everyone on the panel, but starting with you, Eric, if we can, about, you know, truck traffic, rail traffic, and, you know, the electric trucks that are coming about on the horizon here?
Well, electric trucks definitely seem to be, and electric vehicles in general seem to be a trend coming that's developing very, very rapidly. And I know there's an awful lot in the media about that. In addition, we're currently testing an electric locomotive, a road locomotive that can go out on the main lines. Because for us, fuel is a huge component of our operating costs. If we can moderate that cost some way, that's going to be good. Plus, if we can reduce emissions, that's also a positive for us. Because a lot of our customers are also very concerned about sustainable growth, as everyone's customers seem to be these days. From a standpoint of market share, typically, and this has been true over the last several years, trucking handles about 65 to 70% of U.S. freight. Rail handles about 15 to 16%. And then barge, air, pipelines handle the rest. And that tends to be a fairly stable number. And we don't think that's going to change very much. Whether you come in with a different fuel type, say electric rather than diesel, or if you come into autonomous versus actively driven trucks. And part of the reason for that is the scale that exists on the part of rail versus truck. If you think about it, just this past couple of weeks, we reached again the 200,000 unit per week activity level for the BNSF. And we're similar to other Class 1 railroads. We're one of the bigger ones, but very similar. And if you think about it, a train, say that leaves Los Angeles and comes to Chicago, will have between 200 and 300 containers on it. And there are 2 people on that train. So in order to be able to match that scale with individual drivers, there's a long way to go between individual drivers today and autonomous in the future to match that scale. I'm not saying there won't be any impacts, but I think the scale that's available on rail is going to continue to be one of the key factors that drives that to be a major mode of transportation, especially in long haul. Now, in short haul, that's going to continue to be the province of trucks. And in fact, I think I mentioned the other day, some of our largest customers are trucking companies. They're better at the short haul, we're better at the long haul.
Yeah. I think we should all be ready to see electric trucks on the road far before we see any autonomous trucks on the road. I know there's beta testing going on, but obviously in dense urban environments, in that the last mile into the smaller distribution centers, it's just too dense for autonomous vehicles right now, and there's the safety concern. So electric trucking is certainly going to come online before that. And so I think the conversation a few years back, when everyone was all excited about autonomous vehicles, is, wow, we can reduce parking, and it's going to drastically change our site planning. If anything, we're seeing increased parking, right? Though these buildings are becoming more and more automated, they're still labor intensive, which is good for communities. And so that's a positive from industrial, I think. The electric trucking will solve that noise and emissions issue when we start to get closer into residential. As that becomes more and more mainstream, I think industrial won't have such a negative connotation in close proximity to residential. So I think it's an exciting development.
From a power perspective, you know, in terms of these sites, obviously built to suit or retrofits a little different, but what do we have to do to these buildings and site plans if we're going to have, you know, a larger scale use of electric vehicles, trucks on site and all these parking slots? I mean, what has to happen to change those sites around to get to that point, and how long does that take?
Yeah, call ComEd really early on.
Yeah.
The process. You know, we're doing it now for some of the last mile delivery stations where each one of the vans is an electric van, electric vehicle, and they have a charging station. There's 800 of them on the site. It's an immense amount of power.
Yeah.
So as the trucking fleets change over to electric, you're going to have charging for all those vehicles likely at the building. You're not going to, you know, have truck stops be the only place that those trucks can charge, would be my estimation. So really, I think it's a power challenge and getting that infrastructure into the site. So I'm not sure it changes the site plan a whole lot, but it changes the amount of power distribution and power to the site. So there's definitely first cost involved with that.
Along those lines, also, Cameron, I would say that in terms of power to the site, having dual feeds to an industrial park is going to be critical. We just installed new wide span cranes at our large intermodal facility down in Elwood, and they're all electric. So we had to bring a new bus bar to be able to operate them. And we needed a significant amount of power from ComEd to be able, to your point, to be able to provide that service.
Yeah. One thing we are doing with industrial buildings all around the country and in the Midwest, maybe not so much in the Midwest, is increasing the capacity of the roof to be ready for a solar array. The state of Illinois hasn't gotten around to making the dollars and cents pencil out yet. So we don't see a lot of solar arrays on roofs around here, but it certainly happens in the states where the incentives are in place. And as soon as it, you know, I think over the next 4 years, we probably will see some change along those lines. And, you know, we're talking about all this additional power to the site. You can generate power on your roof by having these solar arrays up there. Most of the time, we see that as going actually right back into the grid and not being consumed on site. However, you know, it is a source of power that I think is untapped right now.
Yeah, and Cameron, to Cameron's point, I think an interesting thing to be mindful of when you're reading news about, you know, how solar is developing and on-site power generation is developing, is to keep in mind, you know, of the keywords behind the meter or in front of the meter. So if you're behind the meter, that's power that's generated on site, whether wind, solar, however it happens, geothermal in some cases, that stays on site and goes to feed the building. And then obviously when you're in front of the meter, that's when, you know, you're giving power back to the grid and supplying, you know, basically trying to level out the peak consumption times, which is late afternoon typically.
Yeah, and to jump in and kind of echo that, more and more of our clients are asking for options to build in for the structural for the solar arrays. Along with, you know, LEED had its kind of big boom. Some developers now are asking for green globe designations, which is similar to LEED, but it's a little more user-friendly on the long-term maintenance, and more and more of our developer clients are asking for options in lieu of LEED, just to stay on the sustainability front. And I know Kevin could probably speak to some of the money coming from the capital that wants to be in, you know, green, low carbon footprint buildings. And I'm seeing more and more requests for the green globes requirement than I have before.
And I know, Eric, you had some information you can share with the attendees here, potentially if we can get that into the chat maybe, or some other method on this topic. So that's really interesting in terms of what's happening with the electric and how that's going to grow and sort of change everything all of us do, frankly, from that perspective, from a valuation perspective, from a you know, underwriting perspective, leasing perspective, you name it. So, Mike, before we get into a little bit more of the micro operational items with David about construction and kind of what's happening with job sites and COVID and all that, I know we had talked about a trend for spec development in regard to cold storage. If we could share some thoughts, I mean, everybody in the group, and Mike, if we could start with you. what's happening to meet this increased demand with COVID and just in general with cold storage?
Well, you're seeing that increased demand, obviously, in cold storage, exacerbated by COVID. Obviously, there's a more of a push for e-commerce, grocery delivery. I know Kroger's doing a lot of work in that space, Amazon. You're seeing folks now addressing that need with speculative development. Obviously, these facilities are very cost intensive. They take a long time to construct, and I know that there's a couple of folks. Hunt Southwest in Dallas has been successful in developing a speculative cold storage facility. Bridge Development Partners is working on another project. I think that's 300,000 square feet around Miami. But you're going to start seeing more of that trend, more of that demand as we kind of push more e-commerce and grocery delivery. And then obviously with COVID, and there's a lot of talk over the last couple of weeks with vaccine distribution and capacity concerns. So I think there's a lot of forward momentum, a lot of trend, and it'll be interesting to see how much growth there is in that sector over the next 5 years.
Yeah, I want to jump in there and talk about this a little bit because it is pretty interesting. And both those projects that Mike mentioned are Ware Malcolm projects. The Dallas project is fully leased. It was leased before construction was complete. And the Miami project that Bridge is doing is in for permit right now. We actually developed a prototype for a speculative cold storage building, and there's kind of two different models. And it's, as Mike mentioned, it's cost intensive upfront to build these buildings. And so one method is to build the building with a typical insulated metal panel skin and a steel frame around the exterior. We are opting to leave the floor out of these buildings because a freezer requires an insulated slab, and these tenants, we don't know how much freezer they're going to need, how much cooler they're going to need. We leave the refrigeration system out of the building, as that tends to be very tenant specific. Some love ammonia, they want to go with an ammonia system, or some like a packaged rooftop system, some other kind. So we make provisions for all these different flexible pieces of the building on the front end by creating flexibility in the building and try to defer some of the costs that are very tenant specific to the user when they come in. So that's one method. The second method is more what we call the box in the box method, where you actually build a precast or a tilt up shell, and you defer the entire cost of the thermal and vapor envelope to the tenant by not putting any liner panel on the inside, not putting the floor in, not hanging the ceiling panels from the roof. So that whole box, the cost of that envelope is deferred to the tenant, as well as the refrigeration system. And so when we're talking about the first costs, when you compare it to a traditional dry warehouse spec building, we could be 3 times the cost of a dry warehouse for that first option that I talked about. That might be on the high end. We might be 20 to 30% more than a typical dry warehouse with the box in the box method. So that method actually, starts to make a lot more sense. But it all depends on, the wants and the needs of the developer and what is the market demand. So it's definitely interesting, and I like it. There was a lot of demand, I think, pent up before the pandemic. The pandemic, as Mike mentioned, is certainly accelerated.
Yeah, and I can chime in on the capital market side a little bit on cold storage spec. What we're seeing at CRG is a large appetite from capital partners, big players in the capital space, to get into the cold storage wave here. And right now, if you take a look at what Lineage Logistics doing, they've got a capital influx. They're aggregating some of the best product in the market and paying top dollar for it. What you're also seeing is, if you're a user that is in a 1960s vintage building, these buildings, a lot of the stuff, looking at Crawford in just off I-55 in Chicago, that's a good example of, it's mostly C-class space that has just been limped along, a lot of deferred maintenance. That's just kind of night and day with brand new buildings that, Bridge and the Hunt family's putting up down in Dallas. So there's a big gap between the two. I think we're going to see a big wave of, new developments across the country, whether it's in Florida, Chicago, Texas, California, Northeast, with this capital that wants to do it. Because you're looking at the market. I was talking to my guy in Atlanta, and there's literally no vacancy in freezer space in Atlanta right now, which is insane. So there's definitely a need for it. There's not a good mousetrap that's been built yet. Everybody's going to go about it a different way. And it's some pretty high cost. So it's a very interesting space. We're keeping a very close eye on it. Maybe we'll try our hands at CRG at one in 2021, maybe 2022, depending how it plays out. But a very, very interesting, fast-growing space.
Yeah, between that and the data center influx, I mean, I think we've got a couple of asset classes that are really taken off. I mean, aside from all the warehousing and I don't know if we have any time, if anyone wants to share any thoughts on data centers and construction in that regard, but got a few moments. Otherwise, David, I know we had talked about kind of what's happening, and we hate to bring up the COVID again. Nobody wants to have it front of mind, but it has affected job sites. It has affected day-to-day activities in construction, and obviously for users alike. Can you talk a little bit about those impacts, David, and in terms of the supply chain and kind of what's happening on your job sites, what's changed, what in terms of time frame, cost, and when we see an end to that horizon?
Absolutely. Well, obviously, COVID came out of nowhere on everyone, and it's definitely impacted us in the construction world for schedule and impact on job sites. When it first came out, no one knew if we could even continue building, if we were essential, really what this was. And now it's been around for 6 months or so. The CDC has come out with guidelines. We've got much more stringent PPP, and on job sites, our rules and what we require our subcontractors to do, which is reduced our travel, increased all of our project video conference calling, similar for this for a project management aspect. Even some municipalities don't even do inspections. They're more remote video, where we'll do a Zoom call or we'll fly the drone and send them, and they won't even come to the job sites, which has been very unique for us that we have drones in-house. And a lot of our clients who can't travel right now because they're grounded or from out of state, we send weekly drone video updates, which is they absolutely love. And then, we've evolved for our payment and Textura process where we use a web portal called Textura, where we wire pay all of our subs and have electronic lien waivers come in lieu of the old-fashioned check waiver exchange to help get through this. And then we also have implemented PlanGrid across all of our jobs, which helps us through the design implementation phase all the way through construction, to where our subcontractors and clients have full access through a web portal to all the current drawings, can annotate markup, notes, RFIs, submittals, etc. And, our costs have gone up for maintaining the job site from COVID, the additional cleaning that could be required. And, if someone were to get COVID on our job site, our job site schedule definitely takes an impact. And, it's a disruption, but everyone looks to us to still finish on time and under budget. So we've been doing the best we can and updating, some of our job sites require temperature checks and daily logs for everyone who's been on the job site. And if anyone were to get it, we have a deep clean come through that night from our cleaners, which is, added cost that we've been absorbing. And, the bigger thing for me is to focus in on and understand our suppliers, and if their manufacturing facilities have an outbreak and are shut down, being very open and communicating with our clients, as we hit delays for products coming on, which has happened on a few projects, and we've been able to pivot and come up with an alternative stateside solution to the material that they accepted to meet our schedule and deadlines, which with some of these outbreaks, it's driving up cost of material. Yesterday, I got a letter from one of our steel suppliers that costs are going up due to the high demand coming, and they've had some shutdowns in their plants, and which has slowed down supply, which in turn will just increase costs.
And some of those changes may be permanent, and some of those changes we'll be glad to be done with, hopefully in the next few months here. We'll see as the vaccines come online, but it's definitely impacted everyone. And, now we've got, users that are coming in and sort of demanding and asking for certain things in projects that, whether it's a build out of a property or a build to suit or even in the spec stuff that we're putting up. So I'll leave this open to everyone, of course, but Mike, maybe if we could start with you, kind of what are you seeing with tenants in terms of their TI packages, what they're asking for, and everyone with regard to build to suits and things like that, what are people looking for now, and what is all this costing and who's paying for it?
Well, it's a good question. And obviously, we just touched on earlier that there's a lot of requirements and scope, and obviously construction costs that are driving project costs, driving rents. These buildings are becoming much more sophisticated, a lot more FF&E automation that goes into these facilities to maximize the throughput of the facilities. And so we're seeing our tenants requesting that we take on more and more of these costs within our project costs, within our rents, and we're seeing those increases, reflective of that, and we're willing to take that on. We're obviously the rents are increasing, and then and in turn we're seeing initial lease terms push out 15-20 years depending on the level of the capital investment versus maybe more of a traditional 10-year lease. Also, we're seeing a lot of our clients looking at more like well building strategies, thinking about the environment, how they're designing their offices, workspaces, looking at air quality, natural light, water quality, fitness promotion, and the like. Essentially, even promoting hygiene, water stations, with everything that's kind of transpired with COVID. So we're seeing more of that on our end.
Yeah, and as it relates to well building, the topic's been raised to me multiple times over the last 8 months. And I would say that we are seeing that more so in the office sector than industrial. There's not a whole lot we can do in many of these industrial facilities to promote well building. However, in the office component of those buildings, we are taking those things into consideration. The biggest changes that I've seen in our build-to-suit projects is that we're accommodating for that pre-screening space within the office space plan or at the employee entrance, meaning there's temperature check, an automated system that's put into place, and the ability for someone that's already in the building, potentially a security personnel, to take someone out of line, if there's a temperature that reads too high, and then take the necessary measures then. So that's really about the only change that I'm seeing in most of the build-to-suits that we're working on. A lot of it is operational, right? It's how they're managing the folks within the building. It's not so much the physical building itself changing.
Yeah, and one thing actually, I got a question back for you, Michael, is we've gotten the question a couple times about looking at air changes per hour across a warehouse, and then once it's priced out, in doubling or tripling air changes gets extraordinarily expensive. So it hasn't been checked off on an add-on to a TI package. But I'm curious, Michael, if you've seen that and guys taking that more seriously on a build-to-suit level.
It's funny that you mentioned that. Yes, that comes up constantly on a build-to-suit level. And while we talked about cost and rent are getting pushed, and they're willing to pay for that. As far as air changes go, not so much. So obviously, it's an expensive proposition when you increase those air changes. And even with all these different strategies we just talked about, that is the one that continues to be not selected from our clients.
Yeah, I can weigh in a little. I'd say I'm pricing up those religiously on almost every project, and what's more often than not getting selected are the HVLS fans in some sort of combination, or if there's a place in the warehouse that's got a lot of employees, we're doing supplemental cooling instead of air changes an hour, which a lot of our clients want to focus on, their employee turnover and A lot of it's part-time workers that are coming in seasonally, and they have to compete with Amazon. So if they can't compete on a pay scale, they want to compete with an environment. And so I'm putting in a weight room or a workout facility in almost every facility is really important, you know, pre-COVID and even with COVID. And then a couple of things that came up during COVID and projects midstreams, we've adjusted the office space so that people could be further apart on some of our projects, and others, they kind of canceled the office build out and went to a more work from home strategy. And it was all focused on, you know, as Cameron alluded to, check stations that they could have for their warehouse employees that have to be in the building.
And one thing that kind of gets mentioned a little bit is, you know, and obviously we're talking industrial, it's not the terraced garden of the office world, you know, that people are looking for, but outdoor space, open air, you know, natural light, things you can do to get people, I mean, we're obviously, when talking about the Chicago market, that's a lot more difficult, but is that kind of a lower cost alternative that people are looking at, or is it sort of a bypass, keep everybody at home on the office side as much as we can, and then we'll just get back to normal at some point?
We're seeing it on all of our build-to-suits, Peter, doing some type of outdoor amenity in really any environment, whether we're in a northern climate or, you know, southern. Try to provide shading if you're, you know, in the Southwest, and that we get to use it a few months of the year around Chicago. But it's definitely something we're doing on our build-to-suits and spec projects. One thing that we're trying to push for, and as Kevin alluded to, better site plans, is a little bit more green area around the corners of those buildings where the offices might end up. So you're not necessarily putting in the employee patio day one, but the space is there and it's available and it comes in. But that's a big piece of it. It's all about quality of the work environment and employee retention. You know, I think Mike, you mentioned early on that, you know, the real estate is a small piece of this overall deal, right? And labor is a huge piece of it. And so these guys compete with amenities as much as they compete today.
Yeah, we've come a long way from the picnic table next to the truck court with an ashtray on it.
Yeah, so, and we're seeing that on every one of our build-to-suit requirements. Just, you know, keeping, you know, as everyone fights for labor, you know, just trying to have great amenities for their workforce.
And Mike, on this topic, you mentioned obviously that, you know, this kind of an improvement package all costs money, and you know, when people find out how much things cost, they either walk away or they do it. But you mentioned that the lease terms and lease rates escalating, lease terms getting pushed out. Are you finding that, and anyone on the team, are you finding that in general is something that the users that are out there are you know, taking with a grain of salt, moving on? Or is it something they're fighting and you have to kind of educate them on? Are they just demanding what they used to have before, a 10-year deal with low rent, and we want all this stuff? Or are they all realizing quickly in the market that the norm is to extend that lease rate and to increase that rent?
I think you're seeing more tenants understanding that, for the fact that some of these buildings that we're developing are very highly specialized, user-specific buildings. And so they understand that, you know, there's those first costs that need to be recouped, and that there needs to be a longer term commitment, you know, for us as the investor to invest our capital into these projects. So we're seeing more of an understanding when it comes to buildings that are, you know, have a very high level or degree of specialization, I would say.
Yeah, and I would add, you know, Chicago's a big enough market where if you're looking and talking about the speculative side, you know, if you're looking at brand new spec space, say you're taking 50, 100, 150,000 square feet, you know, Chicago's a big enough market where you're going to have a second gen option. And then it gets into, you know, the cost of the new building, the ability to get exactly what you want, and, you know, the associated cost with that versus repurposing a second generation building. And I think a trend that we've seen, you know, late cycle, you know, call it over the past 36 months is those two groups, you know, it used to be more commoditized. It used to just be a knife fight for every last nickel on a rent or on a lease. You know, you're seeing more guys who are investing in their employees, in co-locating office with industrial, you know, justifying a higher spend on warehouse space. You know, and again, like it was mentioned earlier, it's a smaller percentage cost of, you know, the total P&L for most of these businesses. So people are making the conscious effort to, invest more, and that typically comes with, higher work letters, higher rental expenses at the end of the day. But it's still it's not getting so disparate from second generation space. There's still a market out there. Industrial space is still somewhat commoditized, but costs are definitely going up, and people are willing to pay them. So that's what we're seeing in the market.
Yeah, I want to give the example, Kevin, of the Elk Grove Technology Park that Brennan did. We worked on that with them in Elk Grove Village. And a lot of that was being driven by Elk Grove Village and the mayor, wanting, a highly amenitized and nice looking park. That was a challenging site that many developers have tried over the years, and Brennan got it over the finish line. It's been highly successful. The companies that are moving in there typically have a higher percentage of office. They're taking a little bit less square footage, but they're looking for employee attraction and retention. They might have 30,000 square feet of office, and it's engineers. They're looking to get those young folks right out of college and attract them to Elk Grove Village rather than downtown Chicago. You have to create a nice environment for them to work. So they're certainly spending more on just the base rent for that building. Those were upgraded buildings for sure, and they're spending more on their build outs.
That's what we're seeing. So I guess what are, in terms of the tenant, and user must-haves that we think are here now, that are short-term, that people need for right now, and then what are kind of the longer-term must-haves you think that people are asking for now that are going to be here for the foreseeable, 10, 15 years on the horizon? I mean, we talked a lot about the COVID situation, but are there any other things either within COVID or outside of it that are going to be around for a while that we think everyone's going to need?
Mike, maybe you can speak a little bit to this, but I think the grocery home delivery, it accelerated significantly through the pandemic. We all have to wait and see how much of that stays after the pandemic. It certainly introduced a lot of folks who never would have ordered groceries online to groceries online. So it's yet to be seen if that will continue after the pandemic, but it's certainly driving certain asset classes of industrial, like micro fulfillment centers and things like that. So Mike, maybe, I don't know if you want to talk about that a little bit.
And Mike, we talked about Ocado a little bit.
Well, yes. I mean, you're seeing more of that push, and I think COVID kind of introduced a lot of folks to the concept of e-commerce grocery delivery. I mean, there's just maybe a certain generation that wants to go to a store and that touch and feel of purchasing groceries. And to what level it's going to continue, I'm not certain. I think it's here to stay. Obviously, the younger generations have been early adopters and continued adopters. Personally, I haven't been to a grocery store since February, and I don't foresee the need to ever go back. But that's going to be a push. You're also seeing a little bit of a paradigm shift too, with the fact of traditional, the other side of our business, retail real estate development, where when it comes to the grocery business, you're seeing the concept of dark stores, and where some grocery stores, grocery chains are penetrating new markets where they're locating these dark stores, maybe more in pseudo industrial areas, and not even opening a physical retail store in the market. Because of the online grocery. So it'll be interesting just to see how that business plays out over the next 3 to 5 years. But it's here, it's growing, it's rapidly growing business. But at what rate? Once we get through COVID, it'll be interesting to see to what extent possibly that pairs back.
Peter, one of the trends that I think we'll probably continue to see in the future, and it's more of a general locational trend, is facilities locating and industrial developments locating near an intersection of rail and truck traffic. Again, when you think about it, if you have about 85% plus of the freight traffic in the country handled either by truck or by rail, either by rubber tire or steel wheel, there's going to be a need to be close to those points where both modes come together. A good example of that, I think someone was mentioning earlier, Crawford Park up on 55 in Pulaski. The new Target, or the new facility that Hilco developed that's been leased to Target is a really good example of taking a very old industrial asset and reconverting it into a distribution facility, less than, 3 miles from the Sears Tower? Well, I'm dating myself, the Sears Tower. But I mean, it's obvious there's a demand for being that close to the market and have that short of a distance of transportation between the distribution facility and the customers. And the new Target facility is less than a mile from our second largest intermodal facility in the Chicago market. So we're obviously happy about that. But I think that just affirms that whether you're in Chicago or you're in Joliet or any place else where you have an interaction between rail and truck, that's going to continue to be a key driving factor in location decisions.
And we touched a little bit on robotics with respect to cold storage. What about in terms of manufacturing and the warehousing operations that you guys are seeing? Are we seeing a trend towards more robotics? I mean, you read articles all day long about the newest and latest technologies. Some of them are related to manufacturing, some are related to pick and pack, shipping, things like that, getting all these orders out. It seems like with anything else, the industrial kind of moved so quickly. It was a matter of getting everything out, throwing it in a box and moving on. I know we were talking during one of our discussions this week about just the packaging market and kind of what's happening there, what kind of innovative, I mean, you guys all see what you get delivered to your house. The packaging has changed dramatically over time. I mean, you're starting to see envelopes now versus a big box and a small, something inside. You've got the groceries in terms of ice packing and things like that, and all these different products that are going to go in there for the cold groceries. Are we seeing these buildings, are people starting to ask for these accommodations? What's happening with the robotics end of it? And, are those trends going to be, I feel like now that we've got our arms around getting everything distributed and the fact that this is going to happen, this is the market we're in and it's going to be there for a long time. People are starting to micromanage the process. And to your point, Eric, cut down on kind of the shipping packages, get them all onto the train, get them onto the trucks efficiently in a light manner and pack as much in as we can because we need to. So what's out there that we've heard or seen or expected from users that in that space?
Yeah, I guess my quick take on it as the guy with the box, which is how I kind of look at it from a meathead perspective. We don't have a say in the robotics. I'm not even going to pretend to understand the decision making, the investment, payback periods, the financing of all of that equipment that goes on. All that to say, I know it's very expensive, and how I can become a catcher's mitt in terms of attracting the most amount of users, customers, tenants in the space is having the right product, and the right product when it comes to robotics and technology is heavy power, which we've discussed at length, and I'm sure you guys have heard on every single panel that's a trend. And also in particular is floor flatness, which a lot of these very complex MHE systems and automation systems require. So if you can get the basics, the exact shape of the box or location of the box, these are, from my understanding, again, very rudimentary remedial understanding of it, they're highly customizable. So it doesn't have to be perfect. You don't have to be all things to everybody, but typically newer buildings that have heavier power, that have, the brand new flat floors, are suited the best for the latest technologies.
Yeah, and the higher clear heights as well, right? So automation and robotics allow the user to actually utilize that full 40-foot clear height. It's difficult to use the full 40-foot clear with a manned and material handling piece of equipment that is done with a very narrow aisle type arrangement and a man up type piece of equipment. However, it works even better with automation. We are seeing these automation packages cost 1.5 times that of the building itself, if not so if you're doing a speculative building, just higher clear heights, wider bay spacing to allow as much flexibility for those automation engineers to come in and do their thing is the name of the game. If it's a build to suit, you know, we love to have that integrator or those automation engineers on board before we are really designing the building, so that they're far enough along in their process that they can be informing the design of the building. We're really building this less expensive envelope around this incredibly expensive, you know, automation system. That's how we think about it when we know the user is going to have a highly automated setup.
Yeah, to kind of echo what Cameron was saying, definitely on some of the build-to-suits I've been involved with, one with O'Reilly Auto Parts, you know, being involved early and understanding, you know, their automated system inside and how they move material in and out is huge in designing our building. We've adjusted column-based spacings to accommodate the most efficient way for their conveyors and their automation system. And one of the unique facts for the O'Reilly Auto Parts DCs, they feed about 200 to 300 stores. They have about a 40% return rate of product coming back, whether it's deemed obsolete or customers actually returning it to the retail stores. It comes back through the facility, and they need to be able to manage that and sort it back into the racks, or, you know, ship it out and take it obsolete. And one of the things they do it is with their conveying system, and it's highly important in having that design and taking that into account up front on a build-to-suit level, because it's going to adjust your structure potentially more than just the traditional base spacing that speculative provides.
Good. So I think, you know, just on the final topic here, maximizing building performance. I mean, Mike, you'd mentioned that, you know, the concept of more throughput, you know, the more throughput, the better. And looking at our time, we may have to close with this concept and do a wrap up here. But what are your thoughts there?
Just like you had mentioned, I mean, you know, as far as how do you maximize performance and tenant satisfaction, it's just how much throughput can you get? And we've talked a lot just, you know, from the real estate perspective. And as we look at this, you know, kind of through our lens, costs and rents and whatnot getting pushed up. But obviously, you know, these tenants are willing to pay for it. And the way they're looking at justifying this is the, you know, the exponential throughput that they're able to get through these facilities to justify that expense.
And I guess in closing, one last question to the whole panel, if we can kind of go around 2021 and then going forward, is the curve of innovation and building design, you know, the brain work that goes into putting these buildings together, is that curve going to skyrocket up? Is it going to remain the same, flat? What are we thinking? Is technology going to advance that much quicker going forward that we're going to see a lot of changes, or more of the same?
I think we're going to see a lot of advancements in 2021. I'd like to say, you know, keep our eyes on fire suppression technology. That's what's really holding the height of these buildings on. There are some new sprinkler heads and some new innovations out there that are allowing for underside of deck height of up to 50, I think even 55 feet. And so as that becomes more widely accepted by the international fire codes and municipalities, we're just going to continue to see these buildings get taller. So it's pretty interesting stuff.
From a transportation standpoint, Peter, I think one of the things we're seeing is a lot of reactivation of rail lines that had been deactivated to buildings in the past. And if that rail line was built, say, more than 20 years ago or so, which is the case many times, there have to be modifications to be able to meet current industry track standards and to be able to handle current vehicle sizes. So modification of buildings, understanding rail clearance standards, which in part are a regulated item, are going to be important for existing buildings redevelopment. For new buildings, what we're seeing is some developers coming in and planning for the ability to handle both rail and truck at facilities, even though they may not build the rail initially.
Yeah, and I'll just chime in to add, you know, I think, you know, a lot of the innovation comes through, like we talked about cold storage, like we're talking about trends in spec, you know, which was the first topic that we talked about. You know, a lot of what happens in our industry is building upon, you know, what the last guy did. and then trying to improve it just a little bit. And I think we're getting a really interesting point in the market where, you know, there's some great jumps in technology that maybe, you know, developers and tenants are a little slower on the industrial side to adopt. And I think that, you know, coming out of, you know, 2020, yeah, there's some construction going on. Yes, there were some, you know, big lease deals done. But in many ways, for people's long-term, you know, business decisions from a company's perspective, it was kind of lost. You know, everybody's worried about, all right, I gotta, you know, protect the home base, gotta get the toilet paper back in March, gotta figure out what the kids are doing, gotta figure out my employees. And then they really pick their head up in July, August, thinking, all right, well, now I'm adjusting. Now I can think about my business, my, you know, personnel decisions, my infrastructure investment. And I think you're going to see a ton of that, that was pent up, you know, that was delayed from 2020, hitting in, you know, second quarter, third quarter of 2021 into 2022. And things are going to open up and everything's going to rip. And you're going to see just kind of a bunch of momentum, you know, end of next year into the next year. So I'm excited what 2021 has in store.
Yeah, I think I echo that statement as well. We've got a lot of RFPs coming in now for next year and more freezer cooler options and opportunities that are coming in. And then, you know, even data centers, everyone working from home and everything going to the cloud base. I think data centers are really going to start to churn out here in 2021, 2022. And, you know, with everything going to the cloud and e-commerce, you know, we need warehousing to meet the supply demand, but for our demand for cloud-based and doing, if COVID vaccine hopefully works and, you know, we get back to a more normal sense. But I think a lot of companies have adjusted and are used to this whole work from home or more online stuff, and, you know, their need for office space and, you know, bodies in the, you know, in the offices, it's just smaller. So I think that I'm very bullish on data centers and cold storage.
Okay. Well, you know, we're seeing in our business here in terms of packages and incentives and new development and repurposement. I mean, everything you guys are saying is exactly what we're seeing in our office. This funnel sort of is hit now, and it's seems like go time. And I do think there's a lot of innovation in terms of what we're seeing across these product types. I feel like every day is a new day of somebody coming up with a different concept and kind of growing, you know, what we see in industrial and changing, and, you know, whatever new concept might work. So it's good to see. So, and I think, Todd, I don't know if we have any questions that we could take at this point, or if we even have time, but I'll turn it back over to you.
Yeah, I don't see anything in the chat room. I think we're good to go. Yeah, we're good. You all covered it all. And it's go time, right? Everybody online just logged off and they got to work because they're like, Peter, let's go. Let's get stuff done. This is our
Perfect.
time to shine in industrial. Well, great. Well, thank you, everybody. This was wonderful. I appreciate everyone's time, everyone that logged in. Don't forget, this will be on YouTube. I'm behind, so give me like a week and I'll get it up on YouTube. Don't forget to check out our upcoming events. Couple things. I've got a retail power panel coming up next week where we're going to address converting retail centers to last mile distribution. Might be fun. Peter, I think some people from your company are going to be on there,
Yep.
if I remember right. And then January 7th, we have Dr. Mark Dotzer coming to Chicago via the internet to talk about what's going to happen in 2021. And we've got a great kickoff again this year, like we have every year. There should be, I'm expecting double the normal attendance because of people able to log in and check it out. So looking forward to 2021 with all of you. Let's go make it happen. Thanks, everyone.
Thank you, everyone.
Thank you.
Thank you all.
Peter.
Thank you all.
Thank you, guys. Great
Thank
work.
you, everyone.
Here.